If you're planning to retire between 60 and 67, you've got two choices. Retire on autopilot, like most people, and risk running out of money, paying too much tax and missing opportunities, or retire strategically and make the most of every chance to maximize your retirement. So in this video, I'll share 7 key considerations that can make all the difference so that you can retire with confidence. Hey, I'm Chris Trano, founder of superguy.com.au and managing partner at Toro Wealth, where our vision is to be Australia's most trusted retirement planning firm. If you're new here, hit subscribe for regular retirement planning tips, and remember, this is general information only. It's not personal advice, so please read the disclaimer below. Okay, so the first consideration is superannuation access. Turning 60 is a major milestone, and for most Australians, it's the first time that you can access your super, which is especially important if you're planning to retire between 60 and 67. But to access your super in full, you need to meet a condition of release, and one is ceasing an employment arrangement. So if you leave a job after turning 60, you can access the super built up to that point. Even if you start another job straight away, you just won't be able to access any subsequent contributions until you meet another condition of release. Another option is retiring permanently after turning 60. If you declare you've permanently retired, meaning you don't plan on working for 10 hours or more a week, you can access your super in full as well as any future contributions. And lastly, once you turn age 65, you have full access to your super even if you're working full time. So have you thought about which condition that you'd qualify under? Would it be ceasing work, permanent retirement, or just waiting until age 65? Now, here's something most people don't realize. Accessing your super doesn't lock you out of the workforce. You can still go back to work if you want. For example, you could leave a job after 60 and start a new position straight away, or retire and later return if your intentions have genuinely changed. Another way you could access your super from 60 is through a transition to retirement pension, and I'm just going to cover that later in the video. Now that you know how to access your super, let's look at the different ways you can withdraw it and what it means for tax. Consideration number 2, withdrawing your super and tax. So once you can access your super, the next decision is how to withdraw it, and each option has different rules, benefits, and tax outcomes. The first option is an income stream, usually through an account-based pension. It gives you regular income while the rest of your balance stays invested and growing. One of the biggest perks, once you're age 60, the income you draw is completely tax-free. And it gets better. If you've met one of the full conditions of release discussed earlier, the investment earnings inside your pension are also tax-free. The only exception is if you're in a transition to retirement pension. In that case, the earnings are taxed at up to 15% until you fully retire or turn 65. Now, one rule to remember, minimum drawdowns. Each year you must withdraw a set percentage of your balance. So while this option gives you steady income, you need to meet that minimum. An account-based pension is great for steady income, but what if you need a lump sum for travel, renovations, or paying off debt? That's the second option, lump sum withdrawals. So when you're eligible, you can take out part or even all of your super as a lump sum withdrawal. The good news is that these are usually tax-free after 62. The only exception for tax-free withdrawals from super, whether pension or lump sum, is if your balance includes an untaxed component. Then you might still need to pay some tax. All right, we've covered the 2 main ways to draw down on your super, but you don't have to choose just one because many people, including most of our clients, use a combination. So for example, you might set up an account-based pension for regular income and make lump sum withdrawals when needed for things like travel, renovations, paying off debt, or helping the kids. But there's also an alternative of keeping your super right where it is in your accumulation account. And some people do this for strategic reasons. Maybe they plan to return to work or don't necessarily need regular income. And it can also help couples maximizing Centrelink payments. The downside though, investment earnings in accumulation are taxed at up to 15% compared to tax-free in pension phase. Curious about how different taxes affect your retirement? Check out our video 7 types of taxes and smart strategies to reduce them. You'll find the link below. We've looked at withdrawing your super, but what if you're not quite ready to stop work completely? That's where a transition to retirement pension or TTR comes in, our third consideration. So between ages 60 and 65, a TTR lets you access part of your super while you're still working. Many people use a TTR because they're not ready to give up work completely, and a TTR lets you draw between 4% and 10% of your balance each year. And it's often used to top up income if you cut back on hours so that you can maintain your lifestyle. You can also combine a TTR with salary sacrifice to reduce tax and keep growing your super. This is often called a TTR strategy. One catch, investment earnings in a TTR are still taxed at 15%, which is the same as an accumulation account. Your balance only becomes tax-free once you fully retire or turn 65. If you want the full breakdown of how TTR works, check out our video, the link is in the description. And that brings us to the fourth key consideration, how the age pension fits into your retirement plan. If you're retiring between 60 and 67, here's a quick refresher on how the age pension works. The age pension starts at 67 and you can apply up to 13 weeks out. Centrelink checks both your income and assets, so things like your wages, investments, your car, and your super balance. If you qualify, you'll get the full pension. If your income or assets are a bit higher, you may get a part pension instead. If you're relying partly or fully on the age pension, retiring between 60 and 67 means two things to plan for. First, you need to bridge the gap before 67, funding those years from super or other savings. Second, the choices you make between 60 and 67 can affect your age pension entitlements later. Here's how it works. Under 67, super in an accumulation account is exempt from Centrelink's income and assets test. But if you start a super income stream like an account-based pension before age 67, that balance is counted. So if, for example, your partner receives Centrelink payments, keeping super in accumulation may protect those entitlements since it's not assessed until you move it into an account-based pension phase, or withdraw it. Another strategy is moving super from the older spouse to the younger, and this can reduce assessable assets, but you really need to understand the risks and tax implications first. So professional advice is strongly recommended to avoid the potential pitfalls. Have you thought about how your choices today might affect your Centrelink entitlements later? While strategies like shifting super between spouses can help, the biggest question most people have is simple. Will I have enough to fund the lifestyle I want? And that's the fifth consideration, how much super you need to retire between 60 and 67. Retiring in your early 60s means your super may need to last around 30 years, maybe even longer. So have you thought about whether your savings could realistically last 3 decades? So how much is enough? Well, there's no single answer. It does depend on things like whether you'll receive the age pension, when you retire, and the lifestyle you want. But industry benchmarks give us a starting point. So according to the Association of Superannuation Funds of Australia, ASFA, the standard benchmarks are set at age 67 because that's the age pension age. At that age, they estimate you'll need about $595,000 if you're single or $690,000 if you're a couple. If you retire earlier, say at 60, you'll need a larger super balance to support yourself for longer. So roughly $890,000 for a single person and $1.1 million for a couple. Where does your balance sit compared to these numbers? Above, below, right on track? These figures assume that the retiree or retirees are homeowners, have drawn down all their capital and receive part age pension. But those are just averages. Your situation is unique. So how do you find out what retirement really looks like for you? Well, to get a clearer picture of what retirement could look like, you need to consider modeling your own situation with retirement projections. So what are they? Well, retirement projections are long-term forecasts that show how your finances could play out over time based on where you're at now and your retirement goals. And they factor in your super balance, savings and investments, your income sources, lifestyle expenses, one-off costs, and assumptions like the expected investment returns, inflation, and life expectancy. So to model out your situation, a good place to start is free online tools like the Money Smart Retirement Planner, and I'll put a link to that in the description below. You just need to enter in your details and adjust the settings to reflect your situation. Projections will show you 3 key things. It'll show you how much you could spend each year, how your super balance might change over time, and the age that your savings might run out. When you picture your retirement, have you actually run the numbers to see if your money could last that long? Online tools are a good starting point, but at Toro Wealth, we use more advanced modeling tailored to each client's circumstances. So let's move on to the 7th key consideration, contributing to super after you've retired. Even after retiring, you can still put money into super. So for example, if you sell assets, downsize your home, or receive an inheritance, contributions are allowed until age 75. And if you're 60 to 67, there's no work test for personal deductible contributions. That means that you can still grow your super even if you're retired or working very little and enjoy some tax savings too. And you might also qualify for a downsizer contribution, which lets you transfer up to $300,000 per person from the sale of your home into super, and it doesn't even count towards your contribution caps. To be eligible, you just need to be 55 or over and have owned your home for at least 10 years and make the contribution within 90 days of receiving the sale proceeds. All right, we've covered 7 key considerations, but before you make any decisions, here are a few more things that can make or break your retirement. First, your investment strategy. As you head into retirement, it's smart to rebalance your portfolio to reduce risk, but that doesn't mean going completely conservative because you still need growth to make your money last. Next, managing debts. Paying off credit cards, personal loans, or reducing your mortgage can free up cash flow and take the pressure off once you stop working. Then there's estate planning. Your will doesn't automatically cover super, so keep your death benefit nominations up to date. And that way your super goes where you want, quickly and tax efficiently. Don't forget healthcare. The seniors healthcare card doesn't kick in till age 67, so you need to review your private cover and budget for medical costs in the meantime. Next, gifting and asset transfers. Be cautious when gifting or transferring assets to family because they can still count towards Centrelink's income and assets test and may affect your pension entitlements. And finally, emotional preparation. Retirement is a major life event. Like many new experiences, it can feel both exciting and a little nerve-wracking. But ultimately, it should be a time of fulfillment, enjoyment, and everything you've worked for. To help you make the most of it, think about how you'll maintain purpose, structure, and social connection in this new chapter. Retiring between 60 and 67 is absolutely achievable with the right planning and smart decisions. A successful retirement comes from aligning your tax strategies, super choices, Centrelink planning, and the lifestyle that you want to create. Take charge by modeling your unique situation and building a strategy tailored to your retirement goals. For personalized guidance, a retirement financial advisor can make all the difference, and that's where our team can help. At Toro Wealth, we help Australians 55 and above optimize their finances as they head into retirement. Learn more at torowealth.com.au. And if you like the video and want to make smarter retirement decisions, hit that subscribe button. Thanks for watching, and I'll see you in the next one.